Rates on the rise in the US, on hold here in Australia, but still in negative territory in Europe and Japan. We'll have a quick look around the grounds and update our view on interest rates and the Australian dollar as a result. The long-awaited US rate rise was delivered yesterday and leaves our forecast of at least 3 rate rises in 2017 intact. Although the market was disappointed that the US officials didn't lift their tightening bias and kept their dot plot forecast at 3 hikes for the year. As a result, the futures market, which tries to predict where rates will be on given dates in the future, pared back their expectations a little. As the chart shows, the market is punting on US rates, moving from the latest 0.75% level up to 1% by July, but not higher than that. The focus is on core US inflation, which came in on forecast at 2.2%. And while Donald Trump's aggressive policies may risk this outlook, it will all take time to make its way through Congress via the various Senate and House budget committees. Markets are more impatient than that, and so the path of the stock market and currencies may start to diverge from the initial Trump rhetoric. In Europe, no change to their 0 to negative interest rates, and the focus in the EU is on politics, with the Dutch election avoiding a swing to the Party for Freedom, anti-Islam, Eurosceptic party, and so more confidence now that France will avoid a swing to Marine Le Pen's Leave the Euro campaign. Back home, the US rate rise naturally begs the question, when will Australian rates start to rise? And this is where the outlook for China is so important. It's hard to see the RBA cutting rates with our housing market so strong and recent improvements in the trade balance and business sentiment. So the Aussie dollar does seem to reflect the thought that our rates have found a base. It's been a solid recovery since Christmas, but the 72 to 78 cent range is intact, and we will stick with this range and be happy to go with the break whichever side gives way first. The more volatile break may be on the top side, but yesterday's jobs data makes a run through 78 cents more challenging, with a rise in the unemployment rate to 5.9% and also a rise in underemployment. It's still part-time jobs that are dominating, not full-time, which is keeping wages growth very low. No inflationary pressures there. And finally, on the topic of China, our best leading indicator to economic prosperity here, the People's Bank of China followed the US by again putting up their interbank repo rate 10 basis points, partly to temper their overheating housing market. Some common themes to hear, but hopefully more aligned to a stronger outlook in China rather than just rising debt levels. Until next time, that's the market update from Bendigo Bank.